In this podcast episode, Coleman Church, a seasoned trader specializing in emerging markets debt, discusses the complex interplay between ideology, money, and global financial dynamics. Covering a breadth of topics including emerging markets debt, debt crises, the role of global institutions like the IMF, the future of reserve currencies, the stock market structure, and innovations like blockchain and cryptocurrency, Church offers insights into how financial mechanisms shape international relations and domestic economies. He also touches on how investors can navigate the current economic landscape amid global uncertainty. Emerging markets debt began as a solution to the debt crisis of the 1980s, particularly involving Latin American countries that had defaulted on loans primarily held by major U.S. money center banks. The Brady Plan, introduced by Treasury Secretary Nicholas Brady, restructured these debts and collateralized them with U.S. Treasury strips, making the debt more palatable and tradable. This innovation cleaned up bank balance sheets while opening access to a wider global investor base. The asset class evolved from what were called less developed countries, LDCs, to include a wide spectrum of credit products from sovereign debt of emerging economies to quasi-sovereign and corporate debt, denominated largely in hard currency like dollars or euros. Countries use debt issuance to finance government operations, issuing bonds domestically and internationally. Hard currency bonds attract global investors but carry risks, especially when currencies depreciate. The trading of such debt became a global business involving London, New York, and Hong Kong, often subject to volatility due to geopolitical events and economic crises. Debt crises rarely occur in isolation, but are typically intertwined with currency crises and rising local interest rates. When a country cannot service its debt, rapid currency devaluation occurs, followed by spiking interest rates as governments attempt to support their currencies. This spiral inflates import costs, reduces local lending, triggers defaults in domestic businesses, and stifles economic growth. Bond prices plummet to recovery values, reflecting what can realistically be recovered by investors. Historically, crises have rolled through emerging economies frequently. The Mexican peso crisis in 1994, the Asian financial crisis in 1997, the Russian crisis in 1998, the Argentinian debt crisis around 2000, and subsequent events culminating in the global financial crisis, GFC, of 2008. These crises exposed the limits of market confidence and highlighted the need for large, decisive bailouts rather than incremental measures. The International Monetary Fund, IMF, acts as a financial backstop for countries facing debt distress. Its purpose is to stabilize economies, provide guidance on fiscal austerity, and prevent systemic collapse. However, IMF programs are often politically unpopular due to austerity demands like spending cuts and tax increases, which clash with domestic political incentives to cater to voters. Bailouts by the U.S. and allied institutions come in varying forms, from hard bailouts involving direct financial assistance and restructuring to soft bailouts that entail ongoing financial support under negotiated terms. This system has propped up numerous countries over the past 30 years, making it a central feature of global economic governance. Banks, institutional investors, and distressed debt funds all profit in various ways from these interventions, whether through fees, interest, or restructuring deals. Ukraine's debt and financial situation differ from typical emerging markets owing to its geopolitical significance and ongoing conflict. Western powers maintain strong financial and political commitments to Ukraine, both for reconstruction and strategic reasons. This scenario combines public and private financing, posing unique challenges and opportunities. The geopolitical put, or assurance of support, shapes investor confidence and the likelihood of successful debt workouts, which differs from more conventional sovereign defaults like Argentina. Debt obligations diminish national sovereignty by constraining economic and political choices. While all countries incur debt to some extent, those with reserve currencies like the U.S. enjoy specific privileges, such as the ability to implement counter-cyclical monetary policies and finance deficits at lower costs. Still, there is a theoretical limit to this privilege, primarily linked to military dominance, the trustworthiness of the dollar, and the global role of the U.S. as the issuer of the reserve currency. The precedent set by the U.S. and its allies in seizing Russian reserves stored in American institutions during the Russia-Ukraine conflict sent shockwaves globally. It underscored that assets held in Western financial centers may be vulnerable to political risk, prompting countries like China, India, and Russia to increase gold purchases as a hedge against dollar dependency. The dollar has experienced currency debasement when measured against gold and some alternative stores of value like Bitcoin, even if it appears strong relative to other fiat currencies. The Federal Reserve's policies post-GFC, keeping interest rates near zero for an extended period, were designed to combat deflation, which is a drop in prices that can worsen debt burdens and economic slowdowns. Although deflation might seem beneficial for consumers, it undermines economies reliant on debt and borrowing. Currently, there is a run-it-hot fiscal and monetary approach involving tax cuts, rate cuts, and increased spending aimed at driving growth and attenuating the debt problem through inflation and economic expansion. However, history shows that such attempts rarely achieve sustained high growth rates, and Turkey's recent experience exemplifies how cutting rates amid inflationary pressures culminates in runaway inflation and economic instability. The U.S. economy is increasingly polarized, often described as K-shaped, where the upper-income groups prosper while lower-income households face stagnant or declining conditions. This dynamic challenges the sustainability of consumer-led growth, as much of the economy depends on the spending power of the wealthy few. The public equity market has become heavily concentrated, with a handful of large tech companies, the so-called Mag 7, accounting for a disproportionate share of market gains and overall capitalization. Instruments like zero-day expiry options have amplified speculative behaviors and risk-taking, turning parts of the market into near-gambling venues. Passive investment flows and 401k auto-invest mechanisms exacerbate concentration risks, as widespread funds funnel disproportionately into the biggest companies. At the same time, tech infrastructure boom sectors require massive capital expenditures, borrowing heavily against assets that depreciate rapidly, such as semiconductors. This poses the risk of collateral devaluation and potential financial contagion if valuations recalibrate rapidly. Financial bubbles, including the dot-com crash and the housing bubble, exhibit recognizable patterns where exuberance and easy credit fuel asset overvaluation and eventual collapse. Awareness of bubbles often exists before they burst, but momentum and organizational pressures discourage contrarian positions. The podcast highlights how today's markets have parallels with past crises, but also new challenges, especially given the complexity of financial instruments and digital assets. Blockchain technology, distinct from cryptocurrencies but inherently linked, promises to transform the financial services industry by providing secure, immutable, and transparent transaction records. Tokenization of assets, from real estate to consumer loans, can democratize access, reduce transaction costs, and increase liquidity. Stablecoins, pegged to fiat currencies and backed by assets like U.S. Treasury bills, facilitate rapid, low-cost transactions on blockchain networks and create new demand channels for government debt. Yet, questions remain about regulation, transparency, and potential for misuse of such digital currencies. Despite risks, including potential hacking from advances in quantum computing, blockchain's encrypted ledger capabilities offer solutions to long-standing inefficiencies, such as cumbersome title insurance or slow interbank settlement systems. Tokenizing assets like mobile home loans could improve affordability and market function. Gold remains a critical component in the global monetary system, especially as geopolitical tensions encourage countries like China, Russia, and India to accumulate reserves. Unlike public market data, transparency around gold holdings worldwide is limited due to strategic secrecy. Revaluing U.S. gold reserves to current market prices could bolster the country's capital base and creditworthiness, but valuations remain pegged to historic prices below market levels. This undervaluation seems incongruous with how other financial metrics are handled and reflects broader opacity in global reserve management. Post-financial crisis regulations have drastically changed the financial industry landscape. While these regulations aim to increase transparency and reduce recklessness, they have also ushered in high levels of oversight, monitoring, and punitive actions, sometimes arbitrarily carried out by regulators. This environment has arguably reduced the vibrancy and freedom once seen on trading floors. The close intertwining of government and large financial institutions since the bailout era raises concerns about conflicts of interest and regulatory capture, where financial policies may serve political interests rather than economic stability or fairness. Given inflated valuations in U.S. markets and high concentration risk, diversifying internationally, especially into Latin America, where valuations are more attractive and political alignments may shift, is a prudent strategy. Agricultural land and productive real estate, particularly outside overheated urban markets, offer tangible value and serve as disaster hedges. Gold and silver should remain part of a balanced portfolio, although their gains in recent years suggest caution in overweighting. Investors should look for undervalued or distressed assets with emerging growth catalysts and maintain an awareness of structural economic and political risks. While gold currently acts as a global monetary stopgap amid shifting geopolitical and economic realities, blockchain and cryptocurrencies offer the next frontier for global currency systems. Although Bitcoin and similar digital assets may be superseded by future technologies, blockchain's underlying infrastructure is critical to future financial innovation. The interplay between digital currencies and traditional fiat systems, including stablecoins, could redefine monetary policy and capital flows, with regulatory frameworks evolving in response. The ability of governments to control or weaponize digital assets remains unclear, but is a developing concern. Throughout history, the U.S. and allied financial institutions have functioned as global backstops for debt crises, stepping in to stabilize markets and economies in distress. However, the question remains, who supports these backstops if the scale of crises grows beyond manageable limits? Currently, no alternative system exists with the scale or trust to replace U.S.-led bailouts. This reality underscores the fragility and interconnectedness of the global economic system, emphasizing the importance of careful fiscal and monetary management and diversification strategies for both nations and individual investors.